Hey everyone, and thanks for jumping back into the cryptoverse. Today, we're doing a collaboration with PlanB, the author of the very popular stock-to-flow model. He's agreed to come on the show. We're going to basically just discuss a lot of the similarities and differences between the stock-to-flow model, the stock-to-flow cross-asset model, and lengthening cycles. PlanB, it's a pleasure to have you on the show. I'm looking forward to our discussion.
Yeah, man. Thanks for having me. I've been looking forward to this as well. And it's a very interesting and important topic.
Yeah, it is. And I think, most people in crypto, unless they're living under a rock, have heard of the stock to flow model. I know you published it in 2019 and so far it's doing incredibly well. Could you give a brief summary on what it is and how you came to use this model?
Sure, and I will give a little bit of my background as well. So I'm from the traditional finance world. I worked 25 years in traditional finance. I started my career at the trading floor. That was foreign exchange trading. And then I moved on to managing bank balance sheets and insurance balance sheets and pension balance sheets. And those were big balance sheets of around $100 billion. So we did that with the team. I had a lot of contacts and business with investment banks, but also with central banks. And from there, I saw, of course, that not everything is well in the traditional world with negative interest rates and quantitative easing. So I was looking for assets like everybody does that still have a yield, and Bitcoin was one of the things that popped into my onto my screen in 2013. And the one thing that I missed in that world at that moment was a model for valuation. So we have in institutional finance always models to value everything from equities to bonds to derivatives, whatever. But a bit like gold, there was no valuation for Bitcoin. And that's, of course, also because there is no cash flow associated to Bitcoin. No yield, no interest rates. So what I did was took an idea from the commodities world that I knew, the gold world especially, that I later also found in Saifedean's book, The Bitcoin Standard, and that is the idea of stock to flow. Stock to flow is a measure of scarcity, and it's used to compare markets, for example, gold, silver, palladium, platinum markets. So I thought, Saifedean already did that. He put Bitcoin next to all those markets and compared those commodities basically in stock to flow terms. Stock to flow is the stock of something is the reserves that are above ground. So for gold, for example, that would be 200,000 tons. And then you divide that by the annual production of gold, which is around 3,000 tons. So you get stock to flow for gold of a little bit above 60. And you can do the same with Bitcoin. There's, I think, 18.5 million Bitcoins at the moment. That's the stock. You divide that by the number of Bitcoins that are produced every year. And I don't know that by hand, but it's 365 days times 24 hours, times 6 blocks, times 6.25 Bitcoins. Well, and then you divide the two, you get a number close to 56 as the stock to flow ratio of Bitcoin. Well, my idea was to use that stock to flow ratio as an input, as a variable to explain the price or the market value of Bitcoin. So what I did was make a time series with of the last 8 years at the time, with stock to flow as the X variable and the price of Bitcoin as the y variable, and then just fit a straight line through the data cloud. And the chart we're looking at right now shows that line. So you have scarcity, that's stock to flow, on the x-axis. It goes from 1 to 100. And then you have the market value of Bitcoin on the y-axis, and it goes from 100,000 to around, what is it now? Well, a little under $1 trillion. And and then you see the prices, the monthly close prices of Bitcoin. Those are the dots, the colored dots, and they you can see that they grow in stock to flow. It gets scarcer and scarcer, and it grows in market value as well. And I should say, it's a little detail, but both stock to flow and the value are in a logarithmic scale, and that's important, especially for value, because as you can see, we're looking at values over 9 orders of magnitude. So if we don't do a logarithmic value, you would not see any values, say below 10 billion, that would all fade away into a straight line. So it's very important to look at logarithmic scale if you're looking at data that has a range of so many orders of magnitude. And so this model looks at is a linear regression, basically, through the historical data points of scarcity, stock to flow, and value. And that was that's a very simple thing, but that's the stock to flow model. And I later extended that into the stock to flow X, the cross asset model, and that's also in this chart, because you can see the bigger dots in the upper right corner, and that's the silver market, the diamond market, the gold market, and all the way up right, the red dot is the real estate market. And what's very interesting is that if you look at not only Bitcoin through time, which is a time series model, we'll talk about that later, but also if you compare assets across each other, it falls into that same line, roughly. So so the basic thesis for the stock to flow model is that when Bitcoin's scarcity or stock to flow jumped last halving from 25 to 50 or above 50, it gets to the same order of magnitude stock to flow as gold, and the model then says, then value should also grow towards that same market value as gold, which is 10 trillion at the moment, around 10 trillion, and it was around 10 trillion the last 20 years, which are all the purple dots into that big yellow blob.
Right.
But so that's the hypothesis. It's just a hypothesis, and we're tracking that hypothesis now for 2 years out of sample. So after the model was made, and it's been a spectacular journey.
Yeah, to say the least. Yeah, I mean, so far it seems like things are holding out. And I guess the implication behind this model is correct me if I'm wrong, but if we, assuming Bitcoin gets to 100 trillion market cap. By the way, that reminds me, if you don't follow PlanB on Twitter, go follow him. 100 trillion USD. We'll link it in the description below. But when we get to 100 trillion, would you still use the stock to flow model for Bitcoin after it reaches that milestone?
Yeah, that's a great question, because I get that question a lot. It's the infinity thing, right? Stock to flow goes to infinity, and then value should go to infinity as well. It goes to crazy numbers. But I think that indeed, as you say, we can use this model as it is, with the dollar as the denominator for value. We can use it until we reach the value and the stock to flow of real estate, and that's the red dot on the upper right. And yeah, because we can interpolate between all the assets that we know. So silver, diamonds, we're beyond those now. Gold is next, and real estate is next. So, but if we go beyond that stock to flow of 100 of real estate and the value of that real estate market of 100 trillion, there is no data anymore. So we're going to extrapolate then, and then things become really difficult. So
very dubious extrapolating.
Yeah, I've learned at school that's always uncertain.
Yeah,
so
always.
we might do another halving after that, but I want to be conservative.
Right.
And yeah, well, 100 trillion US dollars is a number I like.
Yeah. I have a question for you. So, both lengthening cycles or I should say both logarithmic regression and the stock to flow model they're both linear regression models. It's just a matter of what your coefficient is, right? Whether you're using time or you're using the stock to flow ratio or coefficient. I know it's not, it might not be directly related to time, but I mean, since the stock to flow value is dependent on, right, the supply of Bitcoin, and then the supply of Bitcoin is sort of it's by block, right? But it's sort of based on time as well. Maybe not implicitly. Would you say that it sort of takes into it, like it's a function of time or a function of blocks, I should say?
Yeah, I think it's very similar. So if you look at this chart, for example, it has a stock to flow as the input variable. But if you would change that for time, however you measure it, and we talk about it later probably, but if, for example, you put the months or the days after Bitcoin was introduced in there, you basically have this logarithmic time regression model, or I think that's very similar probably to the diminishing returns or the lengthening cycles view. But yeah, so the models are very similar in a way. There's some differences as well, but I think that's also where we ended our Twitter discussion. I thought it would be a good idea to jump on a call and discuss this, because they are very similar, and it's probably good to look at the small differences and get our definitions right. So what exactly are we talking about? And then we probably see that we're not that far from each other.
Right, and the more we look at the models, I feel like we realize there's more similarities in them than there are differences. Of course, I think if we look at the model, I guess the one question or I guess one thing that could distinguish them is the lengthening cycle model, I guess, would project that the market cycle peak of this cycle should be not in 2021. And so, if it occurs in 2021, then it certainly would call into account lengthening cycles. Now, I guess the stock to flow model would still, so this is, I guess, a question that I'm sure everyone wants to know the answer to. Does the stock to flow model allow for a market cycle peak this cycle beyond 2021?
Yes, it does.
Okay. And could you explain like what you could envision there, how you could see that playing out? What do you think for, say, like the rest of this year, and what that would look like in terms of the stock to flow model?
Yeah, I can. And it's I think one of the main topics of our discussion. And we'll get back to it later and stuff. And maybe it's best to have the stock to flow X model, so the other black background, that one, for explaining it. So one of the major differences between the lengthening cycle, diminishing returns view, and I should say, in my view, the entire technical analysis view of the world and the stock to flow model, stock to flow X model, is that the stock to flow X model is not at all interested or focused on peaks and bottoms. Mm-hmm. So it's a statistical view, and it's looking at averages. It's looking at phases, is what I called them in the Stock to Flow X article. So it's average levels, and you see those levels here in the white, the thick white line. Those are approximately 4-year averages that I'm trying to predict. And the reason that I don't, the all-time highs are interesting, of course, but I don't care at all how high the all-time high will be, where it will be, and that's, I guess, and same for the bottom of the next bear market, if there is a bear market. But and I guess the context of that is that there's a big difference between technical analysis and quant investors in institutional investment companies like me. So, for example, now look at the top of 2017. That was a maybe 1-day event, and 1 day is not enough for a big investor to offload, to sell all his stuff. I think even a week would not be enough to sell your stuff without moving prices in stealth mode. And that's more true for the bottoms. The bottoms are most of them are liquidation events. Those are maybe 1 minute events where all the long the leverage longs the leverage shorts in this case are killed, and I'm sorry, the leverage longs are killed, of course, so they're all liquidated. That's a spike, maybe 1 minute, maybe an hour, but then it shoots up. But that will define the bottom. So it's, for me, it doesn't make that much sense to use all the tops or all the bottoms as the inputs for a model. And I see that a lot on Twitter there. Mm-hmm. So you draw a straight line, for example, between the top of 2013 and 2017, and then you expect the next top to be on that same line. And that's not my view of the world. I'm much more interested in what that average price level will be after, in this case, the halving, and that's what I predict with the stock to flow model, which predicts an average of $100,000, and the stock to flow X model, which predicts an average of $288,000.
Yeah, because if you look at this model, and I mean, as you said, right, this model that you're showing here is not at all concerned with where the peak is. It is more interested in what's the average, where is the actual price of Bitcoin actually spending most of its time. And yes. And during this last cycle, so we spent a ton of our time over here, and we went above it by a few $1,000s, we went below it by a few $1,000s, but what's a few $1,000s among friends? We don't really care about that. You're basically have the line right through essentially what the average price was, not the peak. And so when you look at this model, it certainly seems, from my perspective, that it would allow for a somewhat lengthened cycle. But again, that's not specifically what this model is concerned with. It's more concerned with just getting the average price correct. Is that correct?
Yeah, absolutely. And there's a lot of misunderstanding on Twitter about it, and maybe I'm not clear about it. So I'm very happy I can give that clarity now.
Yeah, I think this is a great way to clarify, because I've seen this chart many times, and I've spoken to you, and I look at it and I'm saying, we could have both. I mean, this model could be very accurate, and it still sort of lead to more debates about which one do people think. But I mean, I feel like they're actually very similar the more we look at them.
Oh, absolutely, and it's always a bit funny when people say the model is so accurate, because in fact the model is not very accurate, right? It's maybe unusable as well for day trading or even monthly trading. It's a very long-term model. Yeah, so it's, and I always say I'd rather be roughly right than exactly wrong.
Right.
So I'd rather have that level, that price level that was, well, around $7,000 in the last cycle, in the last phase. I'd rather have that next level roughly right. And to clarify it a little bit more, so we're looking at the stock to flow X model now. So if we would look, if we go one chart back to the stock to flow model, yeah, that's the one. That shows the famous or infamous, I don't know, 100,000 level.
Yeah.
And it's funny because where that comes from, it's from a discussion with Dave the Wave.
Okay.
Because, yeah, I don't know why, but talking about levels is always difficult in a technical analysis context. So if you have technical analysis people in the discussion, they always want to know where's the top, where's the bottom, etc. And I don't know. I don't know. But they somehow want to know. So the question that Dave asked me is, yeah, well, when is the model invalidated, and when is my model invalidated? The lengthening cycle theory, and so I said, well, yeah, I'm talking levels, $100,000 level, but that means that the peak will be higher than that, right? It will be to be on average 100,000. The peak can be, if we look at 2017
right.
or 13,
right.
It can be, and the errors, that's the white dots below, it can be 3x or even 10x above that level. So I wouldn't be surprised at all if the all-time high, the peak would be 3,000. So 3x the 100,000 number, $300,000. And yeah, so and the same with stock to flow X. So the 288 is an average. So yeah, it wouldn't be strange at all to have a $500 peak in the stock to flow X model. But to get at an average of 100,000 in this cycle, so in the 4 years after the halving, it should cross the 100,000 level somewhere.
And it has to. Otherwise, because at some point we would expect the price to, have months where it goes down and whatnot. So if you want to get an average price of 100K, we got to go above 100K.
Yeah, so I sort of guesstimated that it would be 1.5 years after the halving, so that would be Christmas 2021, easy to remember, and that's where the 100,000 number comes from. But basically, I will be averaging all those 4 years to look at if the model is invalidated or still useful, and exactly at the December. But it's a nice target because it differs a lot from I guess from the lengthening cycle and diminishing return view. Maybe to add one more point, I wouldn't be surprised to see 100,000 before Christmas this year, and then a extension of that bull market towards 288 and maybe 500,000 in 2022. So to answer your question specifically, so the peak could be well after December 2021.
So you would probably say that like a 300K Bitcoin is unlikely to happen in 2021, but a 100K Bitcoin is still very much doable in 2021. Would that be an accurate assessment?
Yes, that's what I feel would be right. But my model, of course, says nothing about that.
Right. Yeah, and I feel like that's what. And I see that too with models all the time. Like we have our model and then we sort of give our projections, our understanding of how we think we're going to get there. But if it gets there a slightly different way, I don't feel like it necessarily invalidates the model. It just, it means that our dubious speculation on exactly how it got to those levels could be slightly off. So far, if you look at this model, we were tracking it pretty closely up until the summer. And we've only just now, fallen a little bit below it. But I mean, looking at other cycles, I mean, this is not really that uncommon. It's not like you expect it to be exactly on the line for the entirety of the cycle. There's going to be some deviations from it, right? I mean,
Yeah.
yeah.
Yeah, and I always like looking at March 2019 when I made the model. So that's in that green area.
Right over here.
In the beginning of 2009. That's very similar to where, so that's well below the model's price prediction, and quite similar to where we are now. And the deviations were huge at the time. And it's very interesting because at that time, I know it very well still, we crashed from 20,000 top to, below 4,000. It was between 3,000, 4,000 when I made the model. And most people, like 80, 90% of the analysts were predicting prices below $1,000. And then I came up with this Dr. Flow model, and no, it will go to 55,000. At the time, it was 55, not 100,000, because I rounded the parameters a bit. Because even 55,000 was a unimaginable number at that time. But you can see the price in March 2019 was well below the model price.
Right. Yeah. I mean, 100K I think is certainly, as the stock to flow model shows, it's possible. It allows for 100K in 2021, but I don't think that would, if it doesn't go to 100K by 2021, that doesn't necessarily invalidate stock to flow, right? I mean, we're still right around the line, even if it takes it a little bit longer. Is that correct?
Yeah, it could be that it stays below 100,000 and then it jumps to 1 million, for example, in the year after, and still average that 100,000 after 4 years.
That would be quite a move for sure.
Yeah. I might be selling at that point a little bit, but
yeah.
It's maybe this Ben, this is a good time to go to the lengthening cycle theory that much more about, and maybe I could learn a little bit there, because I saw some videos, of course, of yours and followed the discussion that Dave the Wave and I had and you and I had, but I'm not an expert in the lengthening cycles theory, because I see it, maybe if we reach 100,000 this year, that would not invalidate the lengthening cycles and diminishing returns theory either.
Right. So I guess it depends on what happens after. Like, I guess the question is, if we hit 100K this year, and then we have an 80% correction and go down, then that would invalidate lengthening cycles. But if we have 100K this year and then go to 150K or 200 next year, then it very much would show that. And I should say another person who's pretty big, into the theory is Bob Lucas. For the 4-year cycle, and so I've spoken with him before on the channel as well, and he's actually very similar in terms of it doesn't really matter where the peaks are, you more so look at the bottoms and whatnot. But this is an interesting chart, and I kind of just want to get your thoughts on this. This is actually the chart that you've shown on your Twitter and stuff. And I generally measure things from what I would call the cycle bottom, not the halving, but I also do enjoy occasionally looking at it as measured from the halving. This is one of the reasons why I've speculated that we would have lengthening cycles, even as measured from the halving. Now, as you and I both know, extrapolation from 2 data points, it's not like we're taking it to the bank, right? We're not going to say that this is something we know for a fact is going to happen. But if you look at, say, cycle 1, which is the light blue line, you can see that, it gave a really great return. And this return far exceeded the returns that we saw after the second halving. Furthermore, the peak from the second cycle, as measured from the halving, occurred later than the peak for the first cycle. Okay, so like this one occurred after 13 months or so. This one occurred after closer to 18 months after the halving. And so, my speculation was just, so far we've seen the cycles lengthen and we've seen their returns diminish. Okay. And so my thinking is I'm not, I think a lot of people have looked at the lengthening cycle model and diminishing return model over the years and feel like, oh, he's just out to get Bitcoin. He doesn't want to see Bitcoin go to, $1 million by 2021 or something. But I just think that we have, if history is any indication, is the way I would put it, there's at least a probable chance, there's a decent probability that this cycle extends further out than the last two. And the other argument is that, which is not as popular of an argument, is that the returns should theoretically diminish. And the reason I say diminish is not only from a looking at the chart and saying, okay, well, it looks like they're diminishing, because you can see again that the last cycle did not go up nearly as much as the first cycle as measured from the halving. And so then I was just speculating, well, then why would we expect this one to go up as much as the last one if the last one couldn't go up as much as the one before that one? From a fundamental point of view, I mean, it just takes a lot more money to move the market, right? And that's why microcaps and altcoins can put in a lot higher gains because their market capitalizations are so much smaller. Obviously, you're fully aware of this. That was generally the thinking behind lengthening cycles and diminishing returns. I want to show another chart before I get your thoughts on this, because I also like to measure it from the cycle bottom as well. And this chart has something that the halving chart doesn't have, and that's the first cycle. And I guess if you've built the model around the halving, then this first cycle is somewhat irrelevant. But I want to at least show all the data, show all of Bitcoin's price history, and show all these major moves, and say, well, if you look at this one, it was about a 700x from the bottom. This one was about a 500x from the bottom. And then this one was a very modest 100x from the bottom, or slightly over 100x, because I think Bitcoin back then went to like 160, or it was somewhere in that ballpark on a wick or something. And then it ultimately went to 20K, but essentially you're looking at $200 to 20K, so you have about a 100x return. Now, the market cycle bottom for this cycle was 3,100 or so, right? Give or take back in December of 2018. And of course, there was also another capitulation in March of 2020 that took us to 3,800. But the cycle bottom in 2018 was 3,100. So my speculation is that, well, so far, all we've seen happen from one cycle to another, whether you measure it from the halving or whether you measure it from the market cycle bottom, because obviously, different people will have their preferences, and we probably should look at all of them just to get the full picture anyways. If you measure it either way, we see not only diminishing returns, but lengthening cycles, because the first cycle, as measured from the bottom, ended after, 250 days or so. The second cycle took closer to 750 days. The third one took, 1,100 days. And so my speculation is just, wow, I feel like there's a higher chance than not that this cycle will ultimately extend further out than the last cycle. And I would say that it would do that whether we want to measure it from the bottom or whether we want to measure it from the halving. And I think a lot of people are starting to like that idea a little bit more than they did back in 2019. Because in 2019, everyone they just want to see it go up quickly, and then everyone, make all their money. We all cash out. We all just do it again in a few years. Now that we're getting closer to 2022, I think maybe more people are getting on board with the idea. Okay, well, what if we can, keep the party going for a little bit longer? That would be, that'd be kind of nice. And that's not as much of a contention. I think it's the diminishing returns. And the reason I say it is for us to go to an ROI that we saw similar to the last cycle, it would mean going up over 100x from the bottom, right? Slightly over 100x. Well, 100x from the bottom would put us at a modest, $310,000. Really, it would be a little bit higher because we know this is slightly over 100. And again, this is a logarithmic scale, obviously, like you use. So the reason why I'm going to get cautious, I would say I'm personally going to be very, very cautious in the $100,000 to $200,000 range, is because 1 to 200K would still technically be diminishing returns, okay? Because in order for us to have diminishing returns, we just, as measured from the cycle bottom, it just means, we can't go above 300K. But as measured from the halving, which is what you have it as, it would mean, not going to over 250, I believe. Because I mean, if I'm just going to do some mental math here, if we're thinking about, the price of the halving of Bitcoin was like what, like 8,500. It was like between $8,000, $9,000. And then the market cycle ROI from the second halving, after the second halving, was about 30x, I believe. I think it was 30x or so. And so a 30x from say 240 would put us over 200K. I mean, a 30, like for instance, like a 30x a 30x from $9,000 would put us at $270,000. A 30x from $8,000 would put us at $240,000. So, I'm looking at that price range and saying, is it possible? Is it possible we put in a return that we put in that's similar to the last cycle? It's possible, right? I'm not gonna. The one thing I've learned with Bitcoin is you never unilaterally say it can't do something, because that's one way to eat your words later on. But I would say that it's not as likely to happen, and so that's why personally I'm going to be getting, I would say, a lot more cautious between the $100,000 to $200,000 range. Like I fully think it can go to 100 to 200K. I would have a harder time, I guess, accepting or thinking about a $300,000 Bitcoin. So I think the way I would navigate that is, I would probably personally, I'd be getting very, very, very cautious. But I certainly would be rooting for everyone who's hoping to ride the wave all the way up to, to 300 or beyond. One common misconception that I would like, I want to clear up is, I think there's a misconception between, say, like lengthening cycles and super cycles, and super cycles, I think, are more so people that are calling for Bitcoin to go to like, 500K to $1 million this cycle. Like they just think it's going to keep going and going and going for the next 5 years or something, and it's never gonna have a substantial pullback. It's never gonna have a substantial bear market. I don't think that, right? I do think we will have corrections. There's gonna be all sorts of things that Bitcoin has to navigate. Obviously, there's government issues that we have to navigate. We're already sort of starting to deal with that now, and that's sort of what I see. I think the cycles lengthen. I think the cycles diminish. But the interesting thing, and I really like this chart of yours, is this chart, because what you're showing is the stock to flow model. And you're showing the logarithmic regression model. And what you'll notice, and I'm speaking to the viewers, I mean, they're more or less the same for this cycle. Okay, and in similar, I've seen some comments where people say, well, does this mean that, they'll say, well, does this mean that Bitcoin is only going to be 200K or 100K by 2025 or 2026? No, that's necessarily not. It's not necessarily true. It's similar to the stock to flow model, right? You can go above the regression line and you can go below the regression line. So I sort of see it moving above and below it. And if you look at the logarithmic regression model, this is what I have, and this is what I would project out for the next couple of decades. Basically, is us probably staying within these bounds and ultimately trending higher, like the stock to flow model would suggest. I think the main question will be what happens over here. Are we going to go to an average price of $1 million, or it looks like slightly over $1 million between 2024 and 2028? Or will we be closer to, say, these levels in 2024 to 2028? So I would say those are probably the two, that's probably the biggest difference between the models. But I think, and I would love to hear your thoughts on all this, because I know I just went off on a pretty long talk there. I think for this cycle, it seems like they could more or less both be in agreement, and then it'll sort of trail off later on, figure out which one it's going to trail towards.
Yeah, and I agree that also for me, that's one of the big questions. The big similarity in this chart shows is that in the long run, if you're a hodler, it doesn't really matter, because both models expect higher prices, and a lot higher prices, and returns that cannot be made with other assets. So it doesn't matter which model you take. If you're a hodler, you can follow both models, and maybe this is a good time to get indeed into some definitions, because if I hear your explanation of the diminishing returns and lengthening cycles view, then it's really based. And maybe we should change to that other charts that compare that one or my version of this. Well, this one will do fine. It's all based on the tops, right? As long as the top, the all-time high is further away and lower than last cycle, then that's consistent with the logarithmic growth model, and well, that's what you expect, and that's of course different with the stock flow model, that it's not looking at the all-time highs, and that's not, especially its definitions are not based on the all-time highs. So for example, with this chart, and it's the same with, maybe we could switch to that other chart, a similar chart that I have, because I know I made some fun of you guys, and I'd like to do that. I know everybody likes to poke sometimes.
Is this the one you're talking about?
When we were at a 10, 11 months point.
Yeah, you said RIP lengthening cycles and diminishing returns.
Yeah. Rest in peace, lengthening cycles. Because, but anyway, I would have expected, and I now understand that's not totally true, because you mainly are focused on the all-time highs, so it's early to call. But I would have expected that red line or the other line in the other chart to be below the blue line, or basically more below the blue line than so that the entire path of this cycle would be lower.
Well, yeah, I fully understand that, and to be completely honest, like, it took me by surprise, right? I'm not gonna pretend like I thought it was gonna go to 64K by April, because I didn't. I didn't. But at the same time, if you look at it from cycle bottom, which I know you're not as you don't, maybe you care more about the halving, but if you look at it from cycle bottom, once upon a time, this cycle was ahead of cycle 2. And that was my argument, and trying to, that was my own way of like rationalizing why this was okay over here, was because I was like, look guys, if you measure it from cycle bottom, we were ahead of cycle 2 at one point, and we didn't ultimately keep pace with it, because if we had kept pace with it, Bitcoin should have already gone to $1 million a few months ago, if we kept pace with it. So that was sort of my argument, where, I think we're probably going to ultimately fall below this cycle. And, honestly, it took longer than I thought it was going to take to fall below it. So, but I mean, now we're below it, and I'm very skeptical that we can get back above it. I'm very skeptical that we can get back above it in terms of like, because I think to get back above it now, we'd have to go up to like 90K by, within the next month or two. I mean, even like right now, like I feel like, I guess it's coming in on a dip right here. So as at this exact moment last cycle, we actually sort of dipped back down. But you can see over here in the summer, it was close to 30x, which would have mean around 90K for Bitcoin. But then it dipped back down to 20x from the bottom. So that would, that wouldn't be as much. So, but I mean, you can see we're we're below it now, and I guess my speculation is that we'll probably stay below it.
Yeah, and as far as the all-time high will be lower and later than the yellow, blue, and orange lines, then it will of course be in line with the lengthening cycles and diminishing returns view, no matter what the path was.
Right.
If we go to that chart where both the stock to flow and the logarithmic, that one, because like we said, I think in the long run there's a lot of similarities. Everything goes, all models predict it will go up, and it's, I guess, in the short run where there's differences as well. So no, let's go one step back, because it's not one chart, same chart.
Oh, sorry.
Yeah. But in our minds, so now the other one with stock to flow, and that's the one. Yeah. Is it just a question, definition thing? Because I know the time model, as I call it, but the logarithmic growth model, I know it very well because that's where I started my analysis for Bitcoin at
Right.
before the stock to flow time. And is it true that this, well, basically a linear regression through log time, log price, that is indeed the view of diminishing returns, the basic underlying mathematical equation of the diminishing return?
Right.
And the,
Right. With
is that true? Because I don't know. Because David Away, for example, doesn't have a formula. I don't think you have a
So
exact math.
the formula can obviously be, it can be expressed in actually a number of different ways. But
Sure.
the main formula that I use is, so it's 10, and then you raise it to the power A times the ln of x minus b, where A and B are fitted coefficients. X is time from January of 2009
Yeah.
when the model started, and the fit is interesting because you can fit it a number of different ways, right? I mean,
Sure.
do you
Sure.
fit it? Do you? And this is I think an interesting thing that I actually don't really talk about that much, honestly. Like I sort of just kind of glossed over it.
Yeah.
These two lines are completely different, and I'll tell you this: I trust the green line a lot more than the red one.
Yeah.
And I should say why. The red line is fit to exactly 3 data points. 3 data points, right? And it's very hard to, so 1, 2, 3. It was only fit to these 3. The green line is fit to what I deem to be non-bubble data, meaning when we're in the bear market, when we're in the accumulation phase, right? When we're in the phase where we're just not doing anything exciting for months at a time. We're just going sideways, plus or minus, a few percent here or there, similar to what we were talking about earlier back in 2019 and whatnot. So the green line is fit to thousands of data points, and then the red line is fit to 3. And so, yes, the idea generally being behind a logarithmic regression model is that the highest gains occur earlier on, right? So these gains are going to happen earlier in the life cycle of the asset, and that it ultimately diminishes with time. But I think from a fundamental point of view, again, it makes sense because, again, it just takes exponentially more volume to move the market every additional 10x, right? It was a lot easier to take Bitcoin from like 1 million market cap to 10 million than it is for it to go to say 1 trillion to 10 trillion. It just takes a ton more money. Now, obviously that money can come from like institutions and whatnot, but I would just argue we need that money to get to those levels. There's another one as well. So this is just Bitcoin.
Can I make one remark here?
Yeah, go ahead.
Because so I like this chart because it shows that indeed the fitting of this we basically use the same formula, but it makes a difference, of course, if you fit through the peaks or the bottoms or through all the data, which is what I do. And that would if there would be my gray line would be in between your green and red line. But indeed, as you said, fundamentally, it has time as an input and it's a logarithmic shape, and it depends on the fitting, which data points you use, etc. And for example, the time range as well, of course, how that line exactly looks like. But so I know this model, this kind of models very well, and I'll let you finish and then go back to that other chart again.
Well, they're one interesting thing is they converge eventually, because I don't think that I don't think that Bitcoin, it's not just going to be able to put in 100x after every halving forever. So I think it makes sense that they would ultimately converge to one another. And they're if I don't actually have the chart on me, I forgot to include it, but if you look at say annualized volatility or something, it is reducing over time, even if it doesn't feel like it. And some years it goes up because it's not like a monotonically decreasing function. But if you go back to 2009, 2010, 2011, the volatility back then it makes what we have today look like nothing, right? Because back then we could go up 10x in a really, really short period of time, and it was fine. There's no issues with it. Today, if we were to go up 10x, I mean, the market would just absolutely be insane if Bitcoin went up 10x from the current prices.
Yeah, and
So, yeah,
that's the difference, I think, in the well, it's not only the lengthening cycle and the diminishing returns view, but the fact that volatility goes down is one view that's hurt a lot.
right.
But I think the distribution of Bitcoin price returns is a distribution that is not that's not normal or even a power law distribution where volatility or standard deviation or variance is not defined. So I would not be surprised if we see a sequel of 2013 and a 10x from here. I think that would be totally consistent with having a normally distributed price pattern, a price returns pattern of Bitcoin. So,
I actually I don't necessarily know that 10x. I mean 10x is a lot. I mean it's one of those things where it's like I would love for it to happen. You know, like I'm not rooting against that to happen. I wonder if Bitcoin really has that in it this cycle. You know, to go to that like 500K. Here's an interesting chart that I want to quickly show you and get your thoughts on. This chart is actually the red line is more similar to what you have on your chart. But the only difference is this chart is of the entire asset class, not just Bitcoin. It looks like Bitcoin because Bitcoin basically is the asset class, but I like to include all of it as well to look at in the model. But one thing that you mentioned that I've discussed as well is that the similarities between 2013, right? Like the double peak here, because that's what I think. That's what I sort of think is happening. Like I think that there's a lot of similarities, and one interesting thing is so let me explain this really quick because I really want to hear your thoughts on it. This chart, the red line is what I'm calling like the fair value of crypto, and anything below it is undervalued, and that's like basically when you want to load up, and then you obviously want to see it go all the way back up to the peak, right? Like this upper regression line. But you can see that in 2013 we had sort of this like first peak that didn't actually make it all the way to the top, and then later on it did, right? Similar to here, like we didn't make it to the top, and then we came back down, and I'm speculating that later on we will. And if you take the percent difference between the white line and the red line and shift it by 100% so that you get the undervaluation here on the logarithmic scale below 100%, this is what you get. And this is why I think that this was not a market cycle peak, because I feel like it's so similar to 2013. Now, I think the main question now is, well, if it's identical to 2013, then it means we need to go up by the end of the year, right? If it's identical, which would basically mean just making a beeline, straight up to being about 900% overvalued, and then the fair value by the end of the year will be about 1 trillion. So that means it would put the total around 10 trillion for the entire asset class, right? And that would be if it happened by that point. But here's another interesting thing. There's actually a lot of other similarities between 2013 and 2017, because if you look here, we came down, we put in this first bottom, right? And then we came up. We did the same thing in this cycle. We came down to the first bottom, and then we came up. And this was that 2019 run, that took Bitcoin to 14K. And then after that, we dumped again, and then we came right back up to the fair value. So we dump back up to the fair value, dump back up to the fair value, and then one final dump before the intermediate peak, right? And then one final dump here before the intermediate peak. And also, the ratios are the same, actually. So if you look at this ratio, 2,000% overvalue to 700, that's about a 3x. And then this one about, it was about 1,200% or so. It's hard to see on a logarithmic scale, and the white line's covering it, but it was about 1,200%, maybe a little less, maybe 1,100. And then the intermediate peak came up to about, around 400 or so. So basically they were similar ratios between the prior peak and then the intermediate peak of 1/3. And And so if you even more dubiously extrapolate from there and take a time ratio, it would actually, it would put the peak further out than 2021. But I just wanted to show that I have a similar regression line that goes to the middle of the data as well.
Yeah, and if you go, that chart, that's all based on peaks again, right? And
the regression line, the red regression line accounts for all the data. It's all the data.
Yeah. So all the lines and analysis on peaks and bottoms are, in my view, less interesting because I see them as outliers.
Right.
A COVID crisis that no model could have foreseen, a China ban where 50% of the mining capacity of the network was relocated to other countries, that no model could have foreseen. So those are outliers, and for me, from a statistical point of view in the modeling, and drawing lines is not something I would do. But I understand your view, and if you go back to that other chart, so I understand this more. So the red line, using all the data points and
that's essentially what you had on your model, I believe.
But if we go to that chart again, so where the stock to flow and that fair price that uses all the data points, and that is a model I know very well because I had that model as my go-to model before I had stock to flow X, stock to flow and stock to flow X. So I basically ditched that model in favor of stock to flow X, and maybe it's interesting to tell you why, because I know the appeal of the of this logarithmic model is it's this nice curve that's not going to infinity, so it feels a lot more realistic, and it's more conservative, so that's also very comforting. But there's actually 5 reasons that I ditched that time model, that logarithmic model for the stock to flow. And the first reason is that it doesn't tell you why and especially when the price rate rises are. So one thing that I notice when I look at the price of Bitcoin is that all the action is in a short period of time, and it can be basically flat, the price, for 3 years.
Right.
And all the action is, if you look well, it's always after a halving. And like you said, there's only been 2 halvings, and now we're in the third halving phase. But so that's not much. But of course, stock to flow doubled before the first official halving as well, right? 2012 November was the first halving, but the stock to flow doubled before that as well, because that stock to flow then was about 8, and it was 4 and 2 before that. But so the fact that the stock to flow model tells you when the big price movements likely are going to happen, that's after the halvings, is extra information that I think is valuable.
Right.
So that's the first reason I thought that would be better. But the second reason is, and it's hard to explain, but I don't like to have time, so the number of months or days after Bitcoin was invented. I don't like to have time as an input variable, because I'd like to have something else that's not time. And
from a fundamental perspective, you'd prefer
from a fundamental theoretical perspective. And actually, if I'm really honest, I don't like time series models as well. So I'd rather have a non-time series models, and maybe
that's why you prefer. That's why you prefer this. You like this one, like the.
Yes, with the other assets in there. So basically, that's stock. That colored line is the time series line, where you see the monthly close, and I just fitted a straight line through there, which of course is a little bit lower for a stock to flow model than the line that you see there. But as soon as you include other assets, and So like silver, diamonds, gold, and real estate in this chart. As soon as you include those in the regression line, in the regression analysis, then then it's not a time series model anymore, and that takes away all the problems that time series models have. They can be spurious. By the way, this model and the time model can be spurious, can still be spurious. It can be a nonsense correlation still. So that's why it's so very interesting to see what's happening now. But a cross asset model, a non-time series model, is much less prone to, has much less chance of being spurious. So that's why I don't like time as an input. I don't like time series. I'd rather have something with other assets. And yes, the fact that you can compare with other assets like real estate, gold, diamonds, and silver is the second reason I prefer this stock to flow model, because then I'm able to compare it with gold and real estate. Mm-hmm. And also, right, you can interpolate, because we have a stock to flow asset 100, which is real estate. So all the time models, all the logarithmic regressions is extrapolation in time, in the future, and we have not seen the future yet, so we don't have data points in our model set, in the data set that we made our model on, with a time, with an input variable in the future. So that's all extrapolation. With the stock to flow X model, we do have data with larger stock to flow than Bitcoin, and that's gold and real estate. So we can interpolate, which is so much better than extrapolation. And yeah, so that's the second point. I prefer the stock to flow over time. The third point is it's basically that halving point again. So that the halvings are so unbelievably important. But the fifth point, let's see, I guess it's 3 points then. The other point is if we go back to the time series and stock to flow combined chart.
This one?
Yeah. So the time models are very sensitive to the data frame that we are using. So if we're fitting the data, which are all fitted on if we fit it on another time scale, say 2010 to 2016, it will be a totally different gray line.
Oh yeah, I would completely agree.
Yeah, and that's not so much the case with stock to flow. Yes, it will differ a little bit, but not that much. So it's much more stable. It's much more robust. The parameters in the regression, and less sensitive to the data range. So that's the last point that I thought. So basically, it's halvings that tell you when the price is going up. It's interpolation instead of extrapolation, and it's less sensitive to data range. So it's even if I would fit it now, with including the red dots on this chart, which are all after I made the model, that would not change the model at all, and it probably would change the gray line a little bit. So that's why I think it's a little bit better, and that's why I went with it.
So if you do fit, you're correct. I mean, when you're correct, you're completely correct when you say, if you fit, because I've actually done that exercise before. I have a chart that shows like if you fit the data, say, like let's just, pretend like you fit the data just through the first cycle, or the first, this first little move, and then you refit it to say the second cycle, and then you refit it through the third cycle. The logarithmic regression curve changes, right? It doesn't stay the same, but the more cycles you have, like now we're in the fourth one, if you measure from the bottom, or in the third one, if you measure from the halving, they're changing a lot less now, I should say. Like the difference between fitting it through say 2017 or fitting it through 2019 isn't even close to being the same difference as if you fit it through 2011 versus say 2013. Like it's more so converging to what I would consider to just be whatever the fair value is. So, but I would agree that yeah, it very much is dependent on what time series you use. So I completely agree with that statement for sure. I guess
maybe one point there, because I think if the Bitcoin price goes to 100,000 or beyond this year, so before Christmas, what I think that would change this gray line.
Well, I think it depends on how long it spends there. You know, I mean, if it spends like a day or two, or you know, if it goes to 100K, or let's say it goes to 150K and it just hangs out there for a couple years, yeah,
sure.
If it goes to 150K and then drops back down to 50K or 80K or something, you know, then it might not change it as much. So I guess
true.
I agree with you.
Very, very true.
Yeah,
then it would be an outlier, right?
Yeah, like it's sort of going back to the whole peak argument that you made is like, okay, well, not a whole lot of people actually sold there because we were only there for a day, you know. As far as the extrapolation versus interpolation, so your main argument is that it's interpolation because there exists an asset class that has a higher that's already gone up higher on the curve. Therefore, we're just sort of interpolating that Bitcoin can make it there. That's sort of the argument?
Yeah.
Okay.
And it's a technical argument, right? It's for time we don't know the future, so that's always, by definition, in time series models, it's extrapolation, and that makes it difficult, or it could be spurious.
Yeah.
And interpolation, that's always more robust, right? Yeah.
Right. Well, because I mean, I feel like at their core, I mean, I would agree that you're like interpolating between asset classes, but at its core, we're both looking at prior data, fitting regression, you know, fitting some type of regression model, and assuming that regression model is going to hold. Because you know, if Bitcoin were to go back to, I mean, I don't think this is going to happen, but like if Bitcoin were to go back to 10K now and then just hang out there for a couple of years, then both models would be wrong. You know?
Yeah, true. And let's be honest about that. I mean, they're both models. We don't know which one is truer,
right?
In a way that it's a closer fit or whatever.
The famous saying, right, is all models.
They can be both wrong, right? If we dip now below 10,000 and spend the next 5 years there, then well, that's what nobody expects, right?
Right. Well, as they say, all models are wrong and some are useful.
Exactly.
And I think that's the important point. Like, I feel like the logarithmic regression model, the lengthening cycle model, the diminishing return model, the stock to flow model, the stock to flow cross asset model, I don't know that any of them are going to get it exactly correct. And I don't even know that there's a way to define them as getting exactly correct, you know? But I think that they all provide value in some way, that, you know, it can get people to see the market in a slightly different way. And, you know, I think that provides value. And as long as those models are, you know, are more or less holding up as time goes on, then I feel like there's reasons to continue to use them. But I mean, at some point, if they get invalidated, they get invalidated. I mean, I don't expect the model, the lengthening, or I don't expect the lengthening cycle model to hold up for the next 100 years. You know, like at some point, it's just gonna, I would assume that it's going to go into some other type of price action. You know, like I'm not claiming that, you know, every halving for the next 100 years we're going to have a slightly longer cycle. I'm just saying that's what we see now. And you're sort of saying a similar stuff, but with your own model, you're saying, well, you know, we're looking at the stock to flow, and we can probably follow it up until it reaches say real estate. But you're probably not going to make the claim that, you know, we can follow it all the way up to, you know 100 quadrillion market cap or something, you know, because we just simply do not know. It's too far out in time to really fully understand.
By the way, if since you're showing this chart, it's want to know your opinion about this. So if you look at the so we're now at this red-orange blob, right? To the right, where you have your, there. No, Bitcoin, sorry.
Oh.
That blob of, that's the data points after May 2020 halving, right? Where the stock to flow is above 50. But if we go back one phase to that halving cycle, that was the 2016 to May 2020 halving cycle. So that with the peak at 20,000 in 2017, what we see there is that it's a little bit below the stock to flow X line, right?
Right.
It came out too low, a little bit too low if you compare it with earlier cycles and the other assets. So and that's an important thing, because for me that means it was too low. It's probably an outlier for some reason, like diamonds are an outlier here,
right,
as well. But I expect this cycle to be on the line again, and therefore that jump from where we are to where we are going, which is gold, the yellow big circle, will be bigger because the last cycle was so low. So, and that's always what I have in mind when I see the diminishing cycle theory, which, and I understand that very well, which makes the case for, last cycle was lower than the previous cycle and was longer than the cycle before that. Mm-hmm. But I always think about this fact that last cycle could be an outlier that's really below where it should have been. And it might be the futures, it might be the ICOs. I don't know why, but that's something I always have. And I would like to hear your.
It's certainly possible, and that's why you can't, extrapolation from a few data points. We can't take that to the bank, right? I think the main thing that we'll have to keep an eye on here is was this one an outlier? Right? Was it an outlier, or was it showing what the actual trend was? That's I don't know. Like I don't feel like we have enough data. So I think what you're suggesting, if I'm not mistaken, is that Bitcoin. Are you suggesting that Bitcoin should or will likely overtake gold by market cap this cycle?
Yeah. Well, the model is saying that we're hitting that straight
right.
black line. So the model, so the gold or a little less than gold, but certainly above, say, 5 trillion.
So 5 trillion would put us what? That would put us. I think 2 to 4.
That's 288.
That's 288. Yeah, because I've always thought that 2 to 4 trillion was a good target for Bitcoin this cycle. I always thought 2 to 4, but that's
I always find it strange that these last cycle, the blue and the red, the blue and the green dots are so compressed and under the model line.
Would you say it's trending that way? Because all of these were sort of on top of the line or above it, and then over here we were kind of clustered over here, but then also below it, and then this one's even further away from it. Would you say that looks like a trend that we're getting further away from the line, or?
Well, that could. That's the other view. That's more like the diminishing.
That's the diminishing return theory.
It's very interesting what's going to happen. I understand very well why someone would have that view, and I see. You could see that line from 1, 2, 3. Maybe 4 phases, which is n is 4, so that's a low number. Or you could see the last phase as an outlier, and that we're returning to the model line again. But time will tell. There's another question, if I may.
Yeah.
If we go back to the stock to flow time thingy, because what I noticed is that on the short-term prediction, what I noticed, not with you, but for example with Dave the Wave, is that he is bearish a lot of time. I think right now he's bearish, right? A Bitcoin price of 20K would I think that's what he expects. Mm-hmm. And I would understand that, because if you look at the red dot right now, the price right now, it's above that gray line. It's above the time model line. So it would be it is to be expected that it goes below that line again, which is
Well, I think the question is when does it go below that line? Does it go below it now,
yeah.
or does it wait 2 years and then go below it? You know, that's the
Yeah. So that's exactly my question to you. What would be your most likely scenario for the end of the year? Because obviously for me that is the 100K. Why?
Yeah.
Because we just had a halving that sort of says that it has to happen now after the halving. But
Yeah.
I'd like to know what your short-term view is, or if you have.
It's kind of funny because like I get asked that a lot, and my short-term views are mostly my short-term views are that people don't have any idea what's going to happen in the short term, and we guess, but it's really really hard to know. Back in the summer, I was like back in April and May and March even, like I was getting pretty bearish. But the reason wasn't necessarily because of this chart. The reason, as I showed, was because of this chart. I was pretty bearish over here because it just felt very uncomfortable that we were ahead of the last cycle, and I couldn't shake that out of my mind that like why are we ahead? Why is diminishing returns, like are we not on diminishing returns? Are we going to outperform it? What's going to happen? So I was somewhat bearish, and I have this this risk. I don't have it on here, but I have this like risk chart that I look at, and it was flashing that it's the highest risk band, but the risk band accounts for diminishing returns. So like diminishing returns was an assumption, and obviously assumptions can get you in trouble sometimes. Fortunately, I was happy to see us come down. Honestly, it was sort of a sigh of relief, and now that we're below the chart, I'm somewhat like I think my perspective on it is I'm somewhat apathetic as to what happens in the next few months, because I ultimately see Bitcoin having a lengthened cycle and going above 100K. I don't think that it has to happen in 2021. I don't mind it happening in 2021. I really don't, and I've been buying Bitcoin every week for the last 3 months. But I think that what happens in the short term is somewhat irrelevant, and I would ultimately look towards that we should trend up over the next, I would say the cycle peak is probably within the next 1 to 2 years. And it certainly could happen in 2022. I don't even want to completely discount the idea of going to 2023, to be completely honest. I know that sounds a little crazy, and maybe it somewhat is. But
no, it would fit the diminishing, the lengthening cycle.
Here's a dubious. Again, we know how one of the things I talk about on my channel a lot is dubious speculation, right? Because we know extrapolating anything is very dangerous, right? Very dangerous. And you can get these like Arrhenius plots where you essentially are plotting. If you plot the peaks as a function of inverse time, which again, I know we're getting back to the time series data, which maybe you're not the biggest fan of, but if you plot like say the moment in time of the peaks, of peak 1, peak 2, and peak 3 on inverse time, and then you extrapolate out only 3 data points. So the problem with extrapolating that is it's extremely sensitive to where the prior three peaks were. So because the 3 peaks were only there for a moment in time, you really don't know how useful it is. But if you did go through that exercise, it would actually put the next peak in the summer of 2023. But then if you use this model and extrapolate out like the time ratio between this peak to this intermediate peak, and then this one to this one, and then do the same thing for here to here, and then this one to the next one, it would actually put the peak in the summer of 2022. So my thinking on the market is that, can it go to 20K? It can. I think it can go to 20K. I don't think it can go to 10K again. It can go to 20K, but it doesn't have to, if that makes sense. Like I don't.
Do you think we reach the upper boundary before we reach the lower boundary again, or?
That's the key to the lengthening cycle argument here, is that I think we'll trend up higher before we trend back down here. So if we go, and one thing I should say that I think a lot of people misunderstand, lengthening cycles and diminishing returns are not mutually exclusive. Like they don't have to both be right. You know, like one could be right and one could be wrong. We could, I mean, I don't believe this is the case, and I know you don't believe it either, but there is at least, you know, one universe in our multiverse that exists where 64K could have been the peak. And if it is the peak, then that means we would have had diminishing returns and non-lengthening cycles. So then if Bitcoin ultimately goes higher than 64K, which I think it will, you know, before it goes back down to the bottom of the regression line. I mean, I would say it could come back down to the red line and still be fine. But if it's going back down here, we're not, you know, this is not lengthening cycles. This would be a shorter cycle. So I would say that I think that it will likely go to the upper line, the upper green line, before it goes to the lower green line. But that doesn't mean there can't be some volatility in here, right? It doesn't mean there can't be some volatility. And I don't really know. I mean, September a lot of times is a bad month for Bitcoin, you know, historically speaking. But I mean, I don't know how much of that is also related to, you know, to China and whatnot and the miners and like the rainy season. I don't know. And I mean, now that might not be an issue. I don't really know. I'm just kind of speculating there. But September is not always the best month. And we've sort of seen that many years. The average return of Bitcoin in September tends to be negative rather than most other months it's not.
Yeah, so that shows us that we both have like similar views or overlapping views, as we concluded earlier. Right. There's differences in the models. There's I think that the time model allows for a lot more wiggle room, but you know, when it goes under the gray line, that would also be good. That would not be good for the stock flow model. But basically what you're saying, and I'm saying the same thing, and correct me if I'm wrong, that 60,000, 64,000, what was it, is not the top, that we go up from here before we go down, and that it might look very similar to 2013 with that difference, that in your view, the peak, of course, would be lower than 2013, because in 2013 we shot up 10x in 2 months, and that would not be.
Yeah, and if you follow the 2013 model, I mean, that's this one, and that would be putting in a 500x from the bottom, which that would put us at about 1.5 million per Bitcoin if I believe if that were to happen. So I mean, that's you know, obviously there's going to be some level of diminishing returns. I think the question is, does it diminish from the last cycle or not? You know, because I feel like most people are not going to say that Bitcoin's going to go to $1 million. Therefore, they would say, well, it's at least going to diminish from this first cycle, the first halving, right?
Yeah.
Because the first halving was just insane gains. I guess the question is it going to diminish from the second cycle?
Yeah. Yeah. Well, I find it very, very refreshing, very, very interesting to see, and you confirm that yes, you are very much looking at the bottoms and the tops and base your models on there. I'm more maybe looking at the averages that you see here as well. I try to, and it's just a different view. The conclusions or results could be similar. But it's always fun to see where they diverge, where they can go.
I think they both have some wiggle room. So I think, and let me just explain. I just want to know if you agree with this. The wiggle room for the time model is it doesn't say when it has to happen. But it just is going to trend up in that direction, right? It doesn't say when the moves have to occur. But the lengthening cycle model, though, it does not have wiggle room in the sense that it will measure it from bottom to top, whether from the halving or from the bottom. So there is no wiggle room there. Like, so if Bitcoin goes to 500K this cycle, then we clearly did not have diminishing returns, right? We clearly did not have diminishing returns. Whereas, and lengthening cycles, there's no wiggle room in the sense that if it peaks in 2021, then we clearly did not have lengthening cycles. So obviously those could easily be proven wrong if either of those things happen. But that's sort of what constrains those models. The main thing that constrains stock to flow, if I'm not mistaken, is you don't necessarily care about exactly when the peak occurs. The wiggle room is that as long as the average price goes to this level, it's fine. But the constraining thing is you would expect the move to occur like around these levels, right? So around where you have it here. So I think both models have their constraints and their wiggle room. It's just that they're slightly different on what they're constraining and slightly different on what the wiggle room is.
True. That's true. If we would, if we go back to the chart with where you measure the faces from the bottom.
Yeah.
That one, yeah. Where would 300K be?
Yeah, so 300K would be at 100x because the bottom was around 3,100. So it would basically put it right on par with the last cycle. So the last cycle was a little over 100x because you can see it goes a little over it. But remember, this is a log scale, so it doesn't always do it justice to know. It's not close to 200x, obviously. But again, the bottom of the last cycle, not this one, but was like around 160. And then we went to 20K. So it was a little over 100x. So if Bitcoin were to match that cycle and go to 300K, then we'd be putting in returns that are very similar to what we did last cycle. And that's what I have a hard time. Yeah, that's where the diminishing cycle, the diminishing returns things come from.
I understand. Well, I think it's pretty clear. And wow, it will be an interesting next 6 months and maybe on 1.5 years. I guess that's the...
Yeah. I think the next 6 to 18 months will be very, very helpful. And I think the cool thing is we can look back and, if the price is just sort of coming up through here and then it comes back down, you could still make a case that both models are still very much useful.
No. I would have to recalibrate, right? if that happens, if it's not on average 100K and it only peaks above 100 and then stays below, then my model is...
Well, I'm saying that, if it comes up here and then it comes back down and we're sort of in this region and, you can see according to this, this is the regression line that you have. It looks like by 2024, the fair value should be coming close to 100K. By the end of 2024, the fair value should be around 100K, which is a few months after you think that the move to 1 million should begin.
Yeah.
Okay. Yeah, I think this is the region that will distinguish the models. Not necessarily
for sure.
I don't think this region is going to distinguish them. This one will be the one that distinguishes them.
Yeah. Well, if we go below the gray line now and stay there for 2 years, then of course stock to flow is gone.
If we go below the gray line for 2 years and lengthening cycle, without putting in a new all-time high, lengthening cycles is gone. I guess the one thing that would not be gone is diminishing returns, right? We still have diminishing returns. We just don't have lengthening cycles.
Oh, right. Yeah, because the peak was earlier.
Right. That's the thing. And I think that's what people it's like you don't have to have both. You could have one and not the other.
Yeah. Interesting. Yeah, it's. I think the fundamental difference is looking at all-time highs and bottoms versus looking at the average and basis,
right.
and what that brings. And I think a combined view is, of course, always adding information. And it's interesting. Right. Yeah, this is a nice one as well.
Yeah, no, I was watching this chart because it got pretty well tested the other day at 29K, but here we are.
Yeah, I'll be tweeting this again when we're entering the dark blue area. It will be around 50, right? Yeah.
Right. Yeah. It seems like we won't be too far into the future.
Maybe for the viewers, I don't know. Most will know this chart, but the dark blue line is where most of the data points are, right? There's like 66% of the data points are in that dark blue zone. It's the one standard deviation zone. The light blue zone is the 2 standard deviation zones, or it's around 95, I think it is. 95% of the data points is there. Sometimes it goes above or below, like at the peak in 2013, it was above.
No one ever gives you a hard time if it goes above it, right? They'll give you a hard time if it goes below it.
That's not true actually. It's when in the beginning of this year when we were at 50,000-60,000, everybody was saying, "Oh, your model is broken. All models are broken to the upside, and we're going into the super cycle," which, by the way, I don't believe in. I think we will have a bear market after the next all-time high, because that's just greed and fear and investor behavior. It's not all rational. And super cycle, of course, is very rational, in line with efficient market hypothesis. But I don't think that that'll be the case. But no, I get hell no matter what, Ben. If it will be broken above or below. Even during that COVID peak in 2020, March 2020, which is a bit similar to now, people said, well, the model's broken because you didn't have COVID in there, and we go to 1,000, blah, blah, blah. Yeah. And then, of course, it bounces right back, like I expect it to do right now.
Yeah, and hopefully we'll ultimately go to these six-figure valuations, and then we'll see. I guess we'll continue to talk about the models. I'm sure I'll want to have you on in the future. Once we have more data points and whatnot, maybe later on in the cycle or something when we can look at the models. But any last points? Do you think this is a good place to wrap it up?
Yeah, I guess so. No more points on my sheet. And well, it was great talking to you, Ben. I learned a lot today. Yeah, also for the viewers, if there's any questions, just put them on Twitter. You can find me on PlanB at $100 trillion USD.
Yeah, and I would encourage, everyone definitely subscribe to the channel if you're not subscribed. But I will link his Twitter. It'll be the first thing in the description below, and make sure you go follow him. He's definitely one of the guys worth following in the space, and he puts out regular updates on the stock to flow model. Even when the price goes down, right? He doesn't shy away. He puts out regular updates, which I think is really great. And so definitely go follow him. It's a pleasure to have you on, and I look forward to having you on in the future as well.
Thank you, man.
All right, bye.